Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Bonjour. Welcome to Cut to the Chase. This is Daniel Lam, your host for the podcast. 3 nights ago, I was told that my former chess student lost one game and wanted to quit the entire tournament. Now, of course, it's always painful to lose games, but then I always feel that quitting is not the right way. You always benefit in the long run if you, quote-unquote, keep at it. The key here is to learn how to adapt and adjust the way you fight. Now, selling everything is what some investors do in tough markets. But that usually is not the best solution, because few investors can expect to reliably time the markets. So if you sell during a drawdown, you will most likely miss out on the sharp rallies that follow. But if you're overinvested in, say, equities, you will be subject to severe drawdowns during the bear markets. So what should you do? You must adapt and adjust, and make sure that your portfolio has a diversified foundation allocation in order to build resilience in a bear market. You need to include some safe haven assets to an existing portfolio in order to mitigate losses in bear markets while remaining invested. Now, let's go to look at some safe haven solutions. With the recent sharp rise in US 10-year yield approaching our key level at 3.5%, high-quality US government bonds are looking reasonable as a portfolio diversifier. They provide positive returns 2/3 of the time during declines in US equities, but also are able to capture some upside in recovery. Gold is the other natural diversifier. Gold has low correlation to equities and offers potential to participate in the ensuing upside recovery, given half of gold's demand comes from jewelry, which tends to rise during improving economic conditions. It is also a very good hedge for structural bear markets. Lastly, high dividend equities can be a source of both income and relative stability during equity market drawdowns. In months when the VIX Equity Market Volatility Index increases by more than 10 points, dividend equities typically outperform the broader market indices. It is also one way to await a recovery while getting paid through dividends, especially in the later stage of any market declines. So if you want to draw some parallel here, holding high dividend equities is a bit similar to the barbell approach that we've been advocating, of having a balanced portfolio between bonds, which give you income, and equities, which gives you growth opportunities. That's all from me today. As always, if you enjoyed this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.